Welcome, everyone. Welcome. We're thrilled to be here. What a day. Beautiful day. Markets are up, well, except for maybe this morning. We've got a gorgeous weekend ahead of us, so it's a lot of fun. So thank you for being here. Today, we're going to be talking about the markets through the eye of the market. So we're talking about Iran, interest rates, inflation, and intelligence, that of the artificial kind. So we've got a full lineup of speakers today. We'll start off with Steve Finerty, our chairman, who's going to put things in perspective from a historical context. Then Ken Crawford, our portfolio emeritus, will come up and talk to us about Iran, oil prices, and what that means to the market. Followed by that, Ward Brown, our director of research, will be talking about interest rates, inflation. And then finally, Jed Ellerbroek, our new star. He was on CNBC yesterday afternoon, if you saw him, but he'll be up talking about AI and what that means to the markets, what that means to the economy, what that means in our backyards, and most importantly, what does that mean to the Argent portfolio? So for right now, we're just going to get settled for a few minutes. Please enjoy your lunch. Steve will be coming up in a few minutes to get us started. And again, thank you so much for being here.
Welcome, everybody. Good afternoon. Logan always jokes at these things that I only talk when the markets are up, and that is absolutely true. So you should be glad that I'm speaking to you today. I'm just going to make a few introductory comments to talk about things. Years ago, we used to quote John Templeton often, and he had a great quote where he talked about the markets when you had a lot of conflicting issues going on. And today we have record earnings. I mean, just blowout earnings across a lot of industries, not just technology. But we've also got more inflation because of the war in Iran, and we've got higher interest rates, and the national debt is beyond comprehension for most people today, and that's true in other countries also. So you got all these conflicting issues, and we got a somewhat controversial administration in Washington. So we're going to test you using John Templeton's quote the way we did years ago. And John famously said, markets are born on pessimism, they grow on skepticism, they mature on optimism, and they go away on euphoria. So we're going to test you. You got to vote. You can only vote once in this election, but I want to know just how you're feeling. If you think about things for the balance of the year, and you think about the political issues and the economic issues and all the other issues and the great stock market that we're having, how many are feeling pessimistic today as you sit here? Okay, pessimistic. How many are skeptical about things today? Optimistic? How about euphoric? I always quote my wife, about 10 years ago, my unfavorite luncheon ever that we had is, I started this and I thought it was going to be kind of a funny little thing to start with, and I said, is anybody pessimistic? And the room was packed and one hand went up and it was my wife's. And I thought, what am I talking about at dinner that I'm having this effect? So I'll try to be more optimistic. Yesterday, when we did this same test, it came out about the same way. I would say skeptical won, but there were a lot of optimistics. That's actually pretty good. We like it to work out that way. If you're pessimistic or skeptical about the stock market or in the economy, if the news is okay to maybe a little bit better, markets go up because you weren't expecting much. So any news is okay news. If you're really optimistic and euphoric, that's bad news, because even when you get good news, markets can go down. So if you're polling an audience, and we have found over the decades, it's pretty accurate. If you got a skeptical group, usually that's a good news for the stock market, so that's encouraging. So what has been happening since last December when we got together? And in our April newsletter, we talked about it being sort of like a Jackson Pollock painting. And for those of you that follow abstract art, I mean, he's got a lot going on. There's a lot of different contrasting things with his splatter paintings that, by the way, are selling quite well. One sold 2 weeks ago at Christie's, I saw, for $181 million, a new record. So his prices are up, and the stock market is also up. But it wasn't in the first quarter. In the first quarter, we had the war in Iran. People forget, I mean, it's only been a couple months, but markets were down 10% on average, and there were a lot of stocks down 30% at that particular point. So there's our Argent drone. It had a very bad impact on the market. What happened next? It was interesting. At the end of March, we actually did get a few phone calls from clients that were really worried and wondering about should we be getting out or changing strategies. And that's always kind of a bullish sign. It worked again this time. Market turned on down. This is one of the best 2-month periods in history, well, certainly in the last 50 years. I think it's in the top 5 of back-to-back great months for the market. So really, everybody sitting in here is at gains today. If you're us, it's a little frustrating because I'll be honest with you. We're underperforming the S&P this year by a couple % in our large cap strategies. And on our other strategies, we're also underperforming a little bit. And the reason is the same as last year. It's a technology-driven market. Everything tech is doing well. If you look at the S&P 500, though, almost 80% of the companies in the S&P 500 are underperforming the average because the 20% that are doing well are related to AI and technology, which is what we're going to be talking a lot, and they are exploding in value. You own a lot of those, but we don't run a tech fund. We run a diversified fund, and diversification hasn't worked as well as it did. It will again. But let's talk about tech. This is a data center. Logan talked about yesterday what data centers used to be. In fact, I remember, and a lot of you remember in your earlier careers, your data center was maybe a closet in your office. And then it grew to be the size of maybe an office in your office. And then it grew to be a square block, the size of a building. And in St. Louis today, we sometimes talk downtown about data centers they're going to build by the foundry or something, and that's a square block. But that's not a real data center. This is a real data center. And in Texas and Arizona and things, and it's not just these buildings in front, it's the buildings all the way in the back and everything. They are measured in square miles. On Bloomberg this morning, they were talking about one that's being built in Arizona, I think. It's 1.5 miles by 1.5 miles. There are over 20,000 workers working on it daily. When it is done in 4 years, their full-time employment is expected to be under 150. During the night hours and things when they have less activity, 25 for this many buildings. The reason tech, though, is exploding is think about how many computers, how many computer chips, how much heating and air conditioning, how much wire needs to go into something like this, and they are building dozens and dozens and dozens of them. And at first we thought, well, it'll be a few here or there. It's everywhere. And the demand keeps growing and growing, which is what Jed is going to talk about. It's also why they're politically controversial. We all love what's going on with AI, and it's fun to see, what you can do off your computer, as long as this isn't built in your backyard. And so we need to talk about that because we hear about it on the news nightly here in St. Louis also. So I'm going to get over it at this point and turn it over to Ken. We do want to talk about other sectors in the market that are doing well. One is energy. And energy's had a really interesting ride over the last 50 years, up and down. We're in an upcycle right now, so he's going to talk about that and put it in a historical perspective. And then we're going to have Ward here come up, and Ward's going to talk about the general economy. The companies in your portfolios are making serious money. I mean, earnings this year, after 2 previous years, are double-digit and growing. The earnings estimates are going up. They're not coming down despite worries about things. It's really, really a strong market. And then we'll have Jed come up, and Jed will talk more about these data centers and other things. I did it yesterday. I'm going to do it again today. We stuck in a slide. I like to pick on Jed because he's a good Iowa boy like I was. And Jed is really, really bright. And we send him on the road every quarter. And he goes to Bloomberg TV, and he goes to CNBC and MSNBC and Schwab TV, all these different things. And it's very good PR for us. And he's really good at it. It's very hard to do because you don't know really what they're going to ask you, and you're on national TV. So we were excited a couple weeks ago. We were underperforming the S&P. We needed kind of a boost to lift our spirits. So Jed doesn't tell us, but at Schwab TV, they asked him to talk about waste management stocks. Companies like Republic and companies like Waste Connections, which we own. We used to own Waste Management stock, which is big. Great. So we're all excited. We turn on the TV, and this comes on. And its headline is, Argent's Garbage Picks. Not the PR we're looking for, but anyway, I'll give you somebody who doesn't have garbage picks. I'll turn it over to Ken, and he'll talk about oil.
Thank you, Steve, and thank you all for coming. As Steve mentioned, I'm going to talk about Iran, which has certainly been in the headlines. I guess when you go to war with the U.S., you get headlines. But as important, or importantly, Iran is one of the largest producers of oil and energy in the world. And that has implications above and beyond the war. So if we look at oil inventories before the war began, what do we see? we were running at about 8 billion barrels around the globe. And supplies were sufficient. I'm sure if you drove your car up to the gas station and you left, you didn't need a defibrillator. Since the war, however, inventories have dropped and dropped dramatically. And simple economics says if you've got relatively sticky demand and supply falls, the only way to clear the market is through price. And that's what we have seen. January of this year, the average price for a gallon of gasoline was $2.80. Today it's $4.30. So in a short 5 months, gasoline has increased by over 50%. And that has created difficult situations for some and difficult decisions for others.
Anyone has to use the bathroom, do it now. We've got another 2 hours before we get to Grandma's. I'm just gonna fill up the tank.
Fill up? Not all the way though, right?
We have to.
But it's $5 a gallon.
I said we have to.
Kids, we're going to have to leave one of you behind.
Difficult decisions indeed. So how did we get into this situation? The simple answer is geography. This is a map of part of the Middle East. You can see on the left the Persian Gulf, on the right the Arabian Sea. From the Arabian Sea you have the Indian Ocean and the rest of the world. In between the Gulf and the Arabian Sea is the Strait of Hormuz. And what Iran has discovered in this war is that it can control the Strait of Hormuz, and by doing so can control shipping. Before the war, on average, 3,000 ships a month passed through the strait. April of this year, 191 ships passed through. So why is this a big deal? It's a big deal because the Persian Gulf generates about 20% of all the oil and natural gas that we use every day. And when you take 20% of anything off the market, you get the price increases that we've seen. The US responded to Iran by blockading Iranian ports, tried to squeeze the Iranian government. So today we have a standoff. But as you would expect, people in the Department of Defense, state, other people in Washington are trying to figure out a way to break this conundrum. And this idea we think is classified, so you probably don't want to talk about it with too many people, but we think it has some merit. So Moses said, "Let my people go." Donald Trump says, "Let the crude oil flow." For people of an age like Steve and I, this is not the first oil shock we've seen. 1973, we had the Arab oil embargo. Oil prices jumped 300%. The US GDP, or our economy, contracted by nearly 5%, and we had a recession. 6 years later, we had the Iranian Revolution. The Shah was deposed. Ayatollah Khomeini came in. We had the Iran hostage crisis. Oil prices increased by 200%, and the world's GDP, or economy, shrank by 3%, and economists coined the phrase stagflation. So two recent and very difficult situations, all driven by oil. And if you remember, this is what you saw. People queuing up to gas stations, waiting tens of minutes, sometimes hours, just to get gasoline, and not infrequently, when they finally made it to the pump, see a sign that said, "We're out of gas." So why aren't we seeing the same kind of effect, at least so far, today? We've got another oil shock, and there are a few reasons. This slide shows the amount of spend that we consumers have on energy and oil. And what you can see is in the 70s, about 5% of our disposable income went to oil. Today it's 2%, at least before the war. So even though 3 points doesn't sound like a whole heck of a lot, when you spread that over 350, 360 million people, that's a considerable change. And remember that we consumers represent 70% of the economy. So if we are being less negatively affected by oil, that's good. As well, from the 1970s to today, our economy has become much more efficient. So today, to produce the same goods and services, we're using about 40% less energy. And one of the reasons why that has occurred is because the makeup of the economy has changed. Now we are much more a service-driven economy. So we don't have heavy industry making steel and tires and et cetera. Instead, we've got people in front of computers. And as you would expect, that means less energy. And finally, and one of the things that surprises me most, is that the US today is the largest producer of oil and natural gas in the world. We have eclipsed Saudi Arabia. So all in, as you can see in the bottom, energy is half as important to our economy today as in the 70s. So although it's difficult, it's not like it was then. Finally, what about cars? 40% of the oil that we use in the United States becomes gasoline and goes into our tanks. And here too, it's a story of efficiency. 1973, again, the first oil crisis, average miles per gallon for cars below 15. And I'm sure as you remember, Ford came out with the great Pinto, the Chevy Chevette, truly awful vehicles, but an attempt to improve efficiency. And since that time, pretty much on a uniform basis, we have become more and more efficient, such that today we are approaching 30 miles per gallon for all the cars on the road. And people expect that efficiency only to increase as we bring in hybrid cars and electric cars. So in sum, we are certainly being affected today by what's going on in Iran and oil prices and gasoline. However, as compared to the previous oil shocks of the 70s, the US economy is much better off than we were then. And with that as a backdrop, I'll turn it over to Ward.
Thanks, Ken. So I'm going to talk to you a bit today about why, given some of these things that are going on out in the world that would seem to cause a bit of indigestion for the stock market, that instead continues to make all-time highs seemingly by the day. Well, we've certainly not had any shortage of headlines. It's hard to imagine how this administration could produce more of them seemingly by the minute. There might have been some while we've been sitting here at lunch. And normally we'd sit here and we'd say to investors, it makes absolutely no sense to react and make decisions in your portfolio according to these headlines that pop up and always have looking back through history. At the time, they seem like very big deals, and it seems like it would make a lot of sense to react to it. And then when you look how the market has responded over time, you realize that wouldn't have been a very good decision. But, for instance, if you're a business owner in Nebraska, let's say, a small manufacturing company, and you're deciding whether or not you want to hire someone or you want to buy or invest in your business or buy another company or whatever it is, you're probably not all that concerned about what's going on in Iran. But that doesn't mean that some of these things haven't had an effect, because they have. Most especially if you look at something like inflation. Inflation did get better for a few years coming out of the COVID spike, but as you can see, it stayed well above the Federal Reserve's target, which is this gray 2% line, for a while now. And that causes a problem, and certainly here recently, when you take into account the increase in gas prices and some of the supplies that are harder to get, inflation is turning up again. And that causes trouble for people that are dependent on being able to afford things, business or consumer. Consumers especially are feeling it.
Everything okay, ma'am?
It's just that you've only scanned a few items and it's already $60. I'm so scared.
Okay, I'm a trained professional, ma'am. I've scanned a lot of groceries. I need you to stay with me. This isn't going to be easy, so I need you to be brave, all right?
Oh my God! The numbers are going up so fast! Can't you just scan something less expensive?
I can, but let's not forget, it's the little things that add up, all right? Now brace yourself. I'm about to do the mixed nuts.
Oh my God,
Right. So it's pretty funny, and that's true. But if you're someone where things aren't as easy and you're in the grocery store and all of a sudden it's a lot more expensive to get everything, it's not as funny. For instance, if you look at the last inflation report, the cost of fruits and vegetables, and they've jumped a whole bunch. And one of the reasons is that fruits and vegetables are transported on trucks that are fueled by diesel. And diesel prices have exploded. In addition, it's not just oil that flows through the Strait of Hormuz. About a third of the world's fertilizer does too. So over time, those things, with some of these issues that have happened, create some consternation in prices that we are seeing. I feel it personally. I'm a creature of habit, and every week I buy a pint of blueberries. And for a long time, that pint of blueberries is about $3, $4, or $5, depending on where we are in the year. It's been that way for a long time. But here recently, it's more like $6, $7, $8, $9. There's a notable difference. And if you add that up to everything else going into your shopping cart, it's a whole lot. So we can all see the squiggly lines on a chart and say, okay, yeah, they're telling me inflation's up, but every one of us feels it. Our daughter just finished her junior year down at Georgia in Athens. So we fly down to Atlanta. The cost of that plane ticket from her freshman year to her junior year has more than doubled. And I'm sure every one of you has experiences that are just like that. For me, Ken referenced it. Filling up my car now, it was $45 about 3-4 months ago. Now it's $75. If you're someone that has to pay a lot of attention to that, that's pressing on your ability to spend money on other things, and that matters. In addition, if you're the new Federal Reserve Chair coming in and you're looking at things like inflation, you're going to have a hard time cutting interest rates given what's going on. And a lot of people were expecting rates to have come down. A year ago at this point, the market was expecting we would have had 4 interest rate cuts from then to now. We haven't seen that. And in fact, the market's now pricing in the potential for an interest rate increase. And so that presses on things like housing that's very dependent right now on rates coming down and things getting less expensive in order to allow for more activity. Plenty of demand, enough supply, it's just too expensive. And yet, here's what the market's doing, right? And everyone knows that the market continues to power ahead. So why is that? And if you were to ask that question and say, what are the legs on the stool holding this up? Right now, we have some pretty good ones. The first one is just general economic activity. The fact is the demand environment really across the board has held up very well. We get a lot of economic data. There's a manufacturing piece of information we get every month. It just gives us a read on how the manufacturing economy is doing. And it's been strong and expansionary every month this year. And the latest reading we just got in May was the best in 4 years. Secondly, incomes have been rising. Wages go up, that's good for everyone. You have more money in your pocket. That slowed down some here recently, is not as good as it was the last few years, but still, income's rising. And that helps consumers to keep spending. 70% of the economy is consumer and service oriented, as Ken referenced. So consumers are making more money and they're turning around and spending it. We just finished the first quarter earnings season, and if you listen to what Costco said, or Dick's Sporting Goods, or Best Buy, or any of the credit card companies, or industrial businesses, or anything else, not just AI, for the most part, what they said is, we're dealing with some issues like higher prices or costs and things, but our demand environment is pretty good, and consumers are coming in and they're spending money. And lastly, you have underappreciated government spending. You're no longer getting stimulus checks or any of those things that were happening a few years ago, but through the tax bill and some other things, there is a lot of money going back into the economy from the government. We just got through the latest tax season, and much higher than average. There was about $300 billion being returned to taxpayers. So the government is also stimulating the economy. If you look at the next leg, we have client meetings, and we come into the meetings and we're hearing what they have to say. And one of the points of consternation recently has been a lot of concern that their kid or grandkid or whatever it is going to have a tough time getting a job because AI is going to eat it all up, and they're really worried about the jobs market. But in reality, if you look at what the jobs market's been doing recently, not only has it not been weakening, it's been strengthening. The jobs market has been getting better, not worse. If you look at the jobs data we just got this morning, it was significantly better than expected, and that's been happening in pretty much every month this year and for a while. The only thing that messed it up for a bit was when the government shut down. But the jobs market has been much better than expected. Certainly a lot of that is tied to the AI build out and some of those things Jed's going to talk about, but there is no truth to the fact that the job market is deteriorating right now. One of the interesting pieces of the puzzle that has been contributing to less jobs has actually been the government itself. There was a huge amount of hiring in the government coming out of COVID, And a lot of that has been reversed with the Doge program and some of those things. But in general, the employment market is a positive, not a negative. And lastly, which Steve mentioned, has been corporate earnings. And stock prices follow corporate earnings, and they've been nothing short of outstanding. Last few years have been about teens, mid-teens, and this year they're expecting 20% earnings growth. We just, again, got through the first quarter earnings season, and we pay a lot of attention to what those companies say that make a big difference in the economy, the blue chip names, management teams, where we want to know what they're saying and what they're seeing. And what they're saying isn't that it's perfect, but we listen for someone to come out and say, our business just got a lot worse. It was going great, but this quarter it really turned. And in the last one we just had, essentially no one said that. Again, it doesn't mean that there aren't some issues out there, higher prices and some of those things, but as far as just the general state of their business, it is going extremely well and has for a while. Now, this is something for us, for Argent portfolios, we look for companies that can generate earnings growth like this in good environments and bad, and it's tough to do over a long period of time. One of the things that's been tough recently is that a whole lot of businesses are earning a lot of money, and it's made that less unique, which has pressed on some things for us, but over time, this is much tougher than it's been the last few years. But that doesn't mean that there aren't some key risks. Right? And one of them right now is oil above $100 a barrel. That's problematic. If you look throughout history, you get above that too much, and that starts to weigh on activity. There is a level where oil prices are too low because it's indicative of not enough activity, but certainly also the other way, oil prices that are too high, even though it's less of an impact than it used to be. Right now, we're pretty close to that with the peace deal that might have been off and on 3 times during this lunch today. Oil prices are coming down, and that's a positive. Secondly are interest rates. The 10-year Treasury above 4.5 and the 30 above 5, that can be problematic. If the cost of money is more, meaning you want to go in and borrow if you're a company or a consumer or you have to refinance, if interest rates are high and continue to drift higher, eventually there's some tough decisions you have to make, and that can weigh on activity. And lastly, we have the inflation rate. Above 4% is a problem, and we're close to it. In the last consumer price index reading, which is just a broad reading of inflation, we were at 3.8, so you're very close. So these things will eventually cause some of the indigestion that I referenced when I first came up here. But for now, investors are looking at those other things and saying, yes, we see this, and we see the headlines, and we feel some of the geopolitics. But for now, we care a lot more about the general economy and the jobs market, the money we have to spend, and corporate earnings, and they're all going well. You notice one thing that I haven't mentioned yet, and that's AI, right? And AI is hard to overstate the impact that it's having. There's a reason we've come up, and in these last couple that we've had over Christmas and last summer and some things, we have focused on it because it is right now an enormous part of the activity driving everything in the United States. It's being attributed to about 75% of the GDP growth and 80% of the market gains year to date and about 60% of the projected earnings growth. Now, if you have a diversified portfolio like Argent believes in, and you own other things like financial companies or consumer discretionary or healthcare that's really had a tough time, but we believe in, it's been hard when really the primary thing working to the exclusion of everything else has been tech-oriented and AI. Those companies and stocks have just run away from everything else, but there is a good reason, and it's this. If you look at the landmark investments of the history of the United States, the Louisiana Purchase in 1803 represented about 3% of the U.S. economy when that deal was done. Building out the railroad system was about 2% in the mid-1850s. The highway system and the Apollo space program are like 0.4 and 0.2% of GDP. Right now, the amount of money being spent by the large tech companies to build out the infrastructure we need to use all our AI applications is about 2.1% of GDP. It is a basically unheard of level of investment in the United States, and so there is a reason that a lot of those companies are doing as well as they are. And there's a lot of reason that there's a lot of people who want Jed to come up and talk about it. I really like Tom Keene, always have, reading him, hearing about him. Tom Keene likes Jed to come up and talk about AI as well.
Louis caught up in the data center build out? Are there like 4 data centers in the shadow of the arch?
Not yet, but maybe in a few years. I think St. Charles County, just outside of St. Louis, was the first, if not one of the first counties to ban new data center construction.
Really?
And so the big tech companies basically just move, the county over.
Oh, I'm shocked.
And lo and behold, we'll have data centers popping up all over.
One county over.
Yep, that's right.
That's just amazing.
Yeah. Building one at the old Armory downtown as well.
Yep. So
downtown data center.
Yep.
Everywhere it seems like.
And to expand on what we're thinking about AI, I'm going to have Jed come up now.
Thank you. Good job. Thanks, Ward. All right, so 2 quick points before I get started. First of all, Steve, I apologize. I will never talk about trash companies on TV ever again. And second, so Tom Keene's Bloomberg show is probably one of my favorites. He has a great conversation every time, and he's just as vocal in the commercial breaks as he is on TV. He has an interest in St. Louis. Apparently, before he went into television 25 years ago, he considered moving to St. Louis to work at a local investments firm. So he's always wanted to chat about the Cardinals, ask about local businesses. He's always interested in what Emerson's up to, even knew they moved their headquarters a year or so ago. So anyways, fun to talk to him and keep in touch. Okay, so to artificial intelligence. The demand, we're going to talk about the supply and demand for accelerated computing. What does that mean exactly? The demand for accelerated computing, these data centers filled with NVIDIA's chips, comes from all of the technology activities we do today. So for example, Argent's investment team. 2 years ago, we would take SpaceX's new S1, which is a 200-page filing where they disclose all the information to investors about their upcoming IPO. We would have sat down and spent 3 hours reading that thing front to back. And it's filled with boilerplate and a few numbers that matter a lot and thousands of words that don't matter a whole lot. Today, what we do is we feed that filing into an AI software program and we query it. We ask it questions about the various things that we're interested in. That is demand for these data centers. If you're scrolling Instagram, Meta uses these data centers and the computing capacity inside of them to decide which advertisement is best to show you based on your viewing history. What video it should show you next, what it thinks you'll be most interested in. So all of these activities represent demand for accelerated computing. Meanwhile, the supply, of course, are these now monstrous data centers. The demand is greater than the supply. That condition is leading to a virtuous cycle of sorts that we see repeating basically quarterly when these big tech companies report their earnings. Data center construction leads to growing revenue for those companies as they rent out that computing power, which leads to more profit for those businesses. They earn a high profit margin on renting out that data center capacity. The profit margins are like 35%, so really high. That profit, appears in their bank account as cash, and any spare cash in their bank accounts these days, they are funneling into new data center construction as quickly as they can. And so you see how this is kind of cycling, and one thing is feeding another. There are 4 companies that represent 75% of that data center spending in our country. Those 4 are Alphabet, which is Google, Amazon, Meta, which is Facebook, and Microsoft. Argent's large cap strategy owns all 4 of these companies. 2 in particular are really big investments for us, Alphabet and Amazon. So you see their spending over the 2 prior years that we've completed, this year that we're in today, and then 2027. Those 4 aggregated, their spending on data center construction grew 75% from 2024 to 2025. It grew another 75% this year. And it's projected by investors to grow significantly next year too. What you see here in blue is the projection from investors on average 6 months ago when we last spoke. Today, that virtuous cycle has added another $165 billion onto that projection for 2027. That's a humongous increase to an already enormous number. And so if you follow the cycle we talked about, that leads to a lot of additional revenue. And there in green, is how much we've increased that projection for these companies to 2027 just in the last 6 months. An enormous number. This revenue is recurring. It's repeating year after year, and it grows over time. So really a powerful increase in revenue and profits for these companies, all because they're spending so much money building these data centers around the country. I want to drill down into a couple of these in particular. One of the things the stock market's trying to do today, and has been doing really for years, is assess whether each individual company will be helped by this new technology, these new data centers, these new technologies and software programs, or hurt by them. And for a lot of the big companies, there are many, many impacts. Some are good, some are bad. So the stock market is trying to, kind of assess what is that net. Is AI net positive for each company, or is it harmful? And I think with Alphabet and Microsoft, you can kind of see that in action just over the last year. Alphabet, one of the best performers in the stock market, one of the best performers in Argent's fund over the last year. I think Alphabet's gone from in the AI loser camp to the AI winner camp. And I think what's caused that is a year ago, perhaps even 18 months ago, investors were fearful that that Google page we all visit, the 10 blue links, was going to be less relevant in our lives, used less by us. Why go to Google when you can just go to ChatGPT and type in your query and get an exact answer to your question? But I think what we found as time's gone on, that AI summary Google puts at the top, and the inertia and habit that we all have of going to Google or going to your Gmail app on your phone, we don't change those habits all that quickly. We don't add that many new apps to our phone in a given month. People are still going to Google's website, and in fact, they're clicking on those blue links more than they were a year and a half ago, which I think surprised a lot of people and has led to Google stock being such a strong performer in the market. Conversely, Microsoft, they run a very large cloud computing business where they build data centers and run out the power like we've discussed. But their biggest business is the software products that all kinds of businesses, both big and small, use every day. Microsoft Outlook, Excel, and Office, etc. Investors believe currently that stock is underperformed. It's underperformed because investors believe or fear that those software programs are going to be used less by people in the future, several years down the road, once we build new software programs from startup companies that can maybe offer a better product using this accelerated computing. Meanwhile, Microsoft, of course, is racing to add AI functionality to their existing products. They have something called Copilot. That's an AI tool that appends on top of their software and attempts to make it more useful. So there's a race. There's a race to make software better, and investors currently believe that Microsoft, their future probably looks a little bit less appealing than their past. I don't agree with that. I think Microsoft is an outstanding business. I think it's probably the most deeply entrenched software company in the world with its customers. The typical business doesn't just use one Microsoft software product, it uses 5 or 10 or maybe even 15. A company like Argent, which is a Microsoft firm, we use all the Microsoft software programs, and then we also store all of our data up in their cloud, which they call Azure. So we're deeply tied in with Microsoft. We haven't canceled a single Microsoft product. We haven't even discussed it. I think most businesses are that way. And if you do a survey of enterprises, which companies do, and I've seen many of those, most businesses say that their key technology partner, their most important software partner, is Microsoft. And so we think they have a very bright future. We expect that stock to prove that they belong in that AI winner camp, not the AI loser camp. And we hope and expect they do that over the next year. Okay, so how about the local impact now? Data centers these really large data centers are coming to Missouri, and they're coming pretty quickly. Why do people want to put them in St. Louis? Why do the big tech companies want to put them in St. Louis? Reason number one, it's important to locate these data centers as close to big population centers as you can. The tech industry calls it latency, which just means how quickly can they get back the answer? How quickly can they do the processing in a data center and then get that answer back to you via ChatGPT or whatever app you're using? So being close to the population matters. The tech industry, 5 years ago, their goal was always to build the data center within 10 or 20 miles of a big population center. These things are so big, like Steve's graphic earlier in our presentation showed, you can't really find land to put that thing in St. Louis proper. So now we're moving 25 miles away, 50 miles away, or even 100 miles away to build these things. Reason number 2 and 3, cheap power and cheap water. Missouri offers both. Missouri's electricity rates are quite a bit below neighboring states, and we have plentiful access to water too. That's important for these data centers. And then finally, the red tape, the developmental regulations and processes in Missouri are a lot less strenuous than other states. Here's a map of the state of Missouri and all the data centers that are under construction or have been approved in our community. None of these are on the Illinois side of the river, if you notice. They're all in Missouri for those reasons. Google is building, the first data center to break ground is in Warrenton, Missouri, which is 50 to 60 miles west. That's Google's. That's going to be like a $8 or $9 billion project, and it's going to be going here over the next 18 months or so. The one in Festus, though, has probably got the most media attention over the last year. Some of you guys know what I'm talking about. So Festus was on the front page of the Wall Street Journal just a couple weeks ago. The mayor and city council made an agreement with the data center developer. The deal was the data center pays the city $25 million per year. Festus is a small town, just 12,000 people. Their annual budget for the city is $80 million. So this data center is going to add another $25 million every year. That's an enormous amount of money. Mayor thought that was a good idea, signed up for that. Disclosed it to the people living in the community and the public, and there was an uproar, which many of you know about. So they had local elections. They voted out half the city council already. They're now trying to do a repeal campaign to get rid of the other half, including the mayor. So there's a good chance this data center doesn't get built here, in Festus, even though it was approved. And in that case, just like what we kind of saw in the TV clip, Google or whomever is behind this data center will probably just move down the road to the next community until they can find somebody that thinks, that does want to exchange the big property tax income for the ability to build this monstrous data center. Steve mentioned earlier today that Wall Street Journal article about the city of Phoenix. They showed a graphic, a picture in the article, and it was a data center under construction in Phoenix with literally residential houses abutting it. The house's backyard was right next to this monstrous data center. That's a kind of a crazy thing to think about. I live in Kirkwood, not super pumped about one of those, replacing the city park a block or two away or whatever. So really great opposition to these, and I think it's a really interesting conflict between culture and capitalism. And as we know, capitalism, has a lot to offer. The willingness to pay, the willingness to pay that property tax income is powerful, and they will find cities that are willing to do this. There's been virtually no opposition to the big Google one in Warrenton that I mentioned earlier. So on we go, city by city. We'll see a half a dozen or maybe a dozen of these built here, over the next 2 to 3 years. This was a quote, the Franklin County one, Pacific. They are also considering one of these, and there was a great quote on the STL Today website just a week or two ago. We pulled that out for you. If you can't read it yourself, it says, Franklin County is known for its rolling hills, farmland, rivers, parks, and small town communities. People choose to live here because of the peace, open land, and rural character that have defined this county for generations. It doesn't belong here. That's a beautiful quote illustrating kind of that cultural impact and interest that people have. Finally, the artificial intelligence enthusiasm in the market, it's great. It's propelled our stock market to double over the last 3 years. That's really an incredible thing. Companies are capitalizing on that investor enthusiasm to come public. These 3 companies are going to come public in the next 6 months, starting with SpaceX next Friday. These are the 3 largest IPOs in the history of the country, all happening within a 6-month time period. All of these companies are deeply involved with artificial intelligence. They all manufacture things, create software that is, essential for the future of business in America. It's revolutionizing the country. SpaceX, of course, is doing rocket launches, amongst other things, while Anthropic and OpenAI are really big AI model makers whose tools are going into products being made by thousands and thousands of tech companies around the country. So Really an enormous thing. SpaceX's IPO next week is going to come out at about a $1.75 trillion valuation. That'll make it one of the 15 largest companies in the world by market cap immediately. Anthropic and then OpenAI will come out at slightly lower valuations, but they're going to be in the top 20. So really a remaking, or remaking is maybe too strong of a word, but just a big change in capital markets. And our stock market continues to shift in the direction of technology. Those technology companies are a bigger and bigger chunk of our stock market, our investment portfolios, and it's really a foundational change that's just been happening over the last 5 years, and I think is likely to continue. One note about these three companies: if you are an Argent investor, if you own the big tech stocks, you have exposure to these businesses. SpaceX. Google was one of the very first investors in SpaceX a decade ago. So if you're a Google owner, as Argent large cap investors are, you own some SpaceX. I think Google bought that SpaceX stake for $1 billion. Today it's worth $30 billion. Similar story with Anthropic and OpenAI. OpenAI's biggest investor, their kind of founding supporter, was Microsoft. Microsoft owns 25% of OpenAI. So same thing there. And then finally, Anthropic. Amazon is probably the biggest backer of Anthropic so far. So, Argent large cap, big owner of Amazon, you own some Anthropic. So, we're going to see huge valuations for these companies just here over the next couple months. Okay, final thoughts. The doubling of the stock market over the last 3 years. I think the biggest kind of fundamental justification for that, or reason for that, is this supply and demand imbalance we described earlier. Demand significantly exceeding supply, which is leading to a humongous cycle of investment, spending, which is leading to revenue and profits. That condition is not going to last forever. It's not guaranteed to last forever. Eventually, supply will catch up to demand, and that'll have an impact on all of the companies that are helping build data centers today. A lot of those are the best performing stocks in our market over the last couple of years. So when does supply catch up to demand? That's perhaps one of the most important questions investors are asking and trying to figure out today. Second, investor enthusiasm is really, it's high today. Investors are aggressive, confident, and we're seeing that in trading behavior. We're seeing that in valuations for businesses, and we're seeing that in these IPOs. Really enthusiastic investor behavior is not a permanent condition. It changes over time. And then finally, valuations for the stock market are on the high side. There's good reason for that. There are amazing things happening in our economy. As Ward and Ken described earlier, our economy is growing. Consumers are spending. Business investment is very high. There's this AI revolution going on. There's a lot of things to be excited about. But that is reflected in higher valuations for equities today. Argent is trying to invest amidst this environment in a diversified and balanced way, while also trying to capture and invest and ride along with a lot of these wonderful changes in our economy. So we want exposure to the biggest tech companies. I've described how we own several of the biggest ones that are really helping to drive our stock market. And we also want to have exposure to other parts of the economy, which also happen to be doing pretty well. Not in the headlines as much today. We're not talking a whole lot about all the wonderful things going on with aerospace and defense companies, for example. The defense budget's strong. All the airlines all the flights are full every day. We all know that. Those companies are growing and doing great. You don't hear about that because all we're talking about is AI today and all of these exciting changes. But we think a diversified portfolio of successful, profitable, dominant companies in their industries is a good way to invest for the long term. It's what Argent believes in. So with that, Logan, can I turn it over to you to wrap us up? Yeah. I'll see.
Well, Judd, I got bumped for time, but really do appreciate you coming here. What I think we'll do is answer the quiz questions, take maybe one or two questions from the audience. We covered politics and religion and money today, so I have a feeling there's going to be some questions out there, and then we'll wrap it up. So on the quiz, one thing I think we failed to mention was that those three that are coming public, their combined profits add up to 0. The largest oil producer The Saudi Arabia of the world is now the United States. And the largest landmark investments, it's Louisiana Purchase number 1, AI 2, Railroads 3, Interstate Highway System 4, and the Apollo program number 5. My table went 0 for everybody on that one. That's a tough one. So, with that, any questions? Yeah.
Who decides what's coming out of these data centers, whether it's correct or not? Who decides that?
Are you're referring to who when we do a ChatGPT query, what's the underlying thing deciding what the response is? Is that right? Yeah. There are a couple. It's a fairly concentrated group. There are like 4 or 5 frontier labs that do the research, build the models that generate those outputs. Those 5 are Google, OpenAI, Anthropic, XAI, which is owned by SpaceX now, and the 5th is Microsoft. So those are kind of the 5 foundation labs that are on the frontier doing the most advanced research and building the most sophisticated models. Those 5. All 5 of those are headquartered out of California, which is probably
So we have to assume that they're correct.
That's right.
I would just weigh in, because we're getting questions a lot from clients, like how can you trust AI, and it's not always right. Well, neither are our employees. We have to verify all that too. AI is extraordinarily accurate in a lot of cases, but just like anything anybody else does at work, it always needs to be double checked and verified. I think, Maggie?
Yeah, wonderful question.
Want to repeat the question?
Yeah, the question was, are these AI labs doing work to try to help the curing of diseases and healthcare in general? I think the answer is yes. If you listen to the Anthropic CEO, Dario Amodei, or if you listen to the head of Google's DeepMind research unit, whose name is Demis Hassabis, those 2 people will both say the number 1 reason they're working on AI is to help people's health, to cure diseases. Google started a healthcare company called Anthropomorphic Labs. They're spending real money and giving lots of effort and time and research time to healthcare. We own in large cap in several of our Argent strategies a company named MedPace. MedPace helps drug companies proceed through the clinical trial process. So they kind of have a ground floor, I think, view of this. And what they would tell you is AI holds lots of promise to help find new drugs, cure new diseases, but the healthcare industry in America moves exceptionally slow. And the FDA approval process is like a decade-plus long thing. So it's going to take a lot longer to get approved drugs to cure diseases using AI tools than it's going to be to make a new cool social media app. So not great news, I think, but there are significant efforts underway to do that. It's just going to take a long time. Yeah.
One last one?
This morning, I think it was that SpaceX got turned down by the S&P 500 for fast track. Any effect at all for them?
Yeah. I think that's, first of all, I saw that. I think it's great news.
Can you repeat it?
Yes, sorry. The question is the S&P 500, which is the organization that decides which companies are included in the S&P 500, which is the biggest equity stock index in the world. They decided that they were not going to change their rule for these big new IPOs. Their rule is, if you IPO, you have to wait a year before you're eligible for inclusion in the S&P 500. Companies want to enter the S&P 500 as quickly as they can because once you get in there, all of the index invested dollars in our country automatically buys your stock. So SpaceX has made a really big deal of saying, hey, S&P, change your rules. We want to get in immediately so we can have a lot more demand for our stock, which is going to make Elon Musk wealthier. The S&P 500 said no to that. I think that's a really good idea. And the reason why is because when companies IPO, their stocks are extremely volatile the first few months. Like they're amongst the most volatile stocks. And most IPOs actually underperform. in the first year when they do IPO. And the main reason for that is companies are coming public, so their private funders, the people who own the company today, can start to liquidate their stock. So in the case of SpaceX, they have a 6-month lockup. They're going to do the IPO on Friday. 6 months from now, a lot of those big current shareholders will be able to start selling. And when they start selling, typically the stock goes down. So I think it's great that the S&P 500 is sticking to their principles, and they're going to force the index funds to wait a year to add companies like these to the benchmark. They had a lot of pressure to change their rules and kind of cave, and they refused to do so. So I was encouraged by that.
All right. Well, thank you all for coming. We really do appreciate it. We will hang around and answer questions. Have a great weekend.